So obviously, one of the biggest concerns right now regarding premium financing are increasing borrowing rates. So what I'm going to do is go through some recent historical data regarding CMT rates as well as SOFR rates, and then get into a new premium financing platform I developed to specifically address these increasing borrowing rate concerns. So what we're looking at on the screen right here, these are historical 1 month CMT rates starting at the beginning of this year, January 2nd, 2003. The 1 month CMT rate was 4.17%. Then we saw it steadily increase, and we saw it peak on March 9th at 4.83%. And then we see it actually plummet quite a bit. This was on March 21st, 2003, down to 4.07%. Then it spiked up again, and then it tanked again. This was actually just yesterday, April 17th, 2023, plummeted back down to 4.09%. So we've seen quite a bit of volatility here, but it does look like the 1 month CMT rates are starting to settle down again. Now, one of our lenders uses the 1 month CMT rate plus a spread of 2.75%. So as of yesterday, the borrowing rate would have been 6.84%. And that is for annual premiums between $1 million and $1.49 million. This is just one of several different lenders we use. I'm just using this as one example. If we go over to historical SOFR rates, this is the 1 year SOFR, and we started out at 4.31% on January 3rd, 2023. Then we saw it pop up to, just north of 4.5%, and it kind of stayed there between the end of January all the way up into mid-March, right around 4.55%. And then we saw it pop up to right around 4.8% just a few days later, and then kind of hover around 4.8% all the way up until April 18th, 2023. One of our lenders uses the 1 year SOFR plus a 1.40% spread, which would have put them at 6.20% as of yesterday. And again, that is for annual premiums north of $1 million. So what I thought I would do is kind of show you the historical relationship between borrowing rates and crediting rates, because what most folks do in premium financing is they're solely focused on the borrowing rates in isolation. And for the last decade or so, a lot of these advisors were selling premium financing based on cheap money, right? In other words, low borrowing rates, which is not the right proposition. And that proposition surely is not working well right now, which is why here we are just past first quarter in 2023, and carriers and IMOs are telling me that their premium financing business is down 60%. And my premium financing business is actually up over last year. Q1 of 2023 is the best quarter I've had in the last 20 years of being in the business. And I think the reason is because for the last several years, I have not been selling premium financing based on low borrowing rates. I've been selling premium financing based on understanding the symbiotic relationship between borrowing rates and crediting rates. So another big concern people have right now is the fact that it appears that we are going to continue to be going deeper into a recession. Whether that's true or not, if that is people's perspective, that is one fear they're going to have regarding premium financing. So in my software, I actually developed a new 40-year synthetic construct here. If you look at the top red box there, we start off with the year 2000. We run that through 2021. Very soon I'll have to update that to 2022. But the reason we start with the sequence is that the first 10 years of this sequence are awful and are, quite frankly, the worst decade within recent modern history. After this 22-year run here, then we are running at a static return. Typically, we'll run it at AG49A max. For this particular design here, I ran it at 5.40%, just to be conservative, which is less than the AG49 max for this particular product. If I blow up the first 10 years of the sequence here, again, We've got 2000 through 2009, which was a terrible way to start out. And we've got 5 negative S&P returns, and they're in column 12, which would mean if this were an actual real world IUL, the index credit would have been 0. 5 out of the first 10 years of the sequence, and even more specifically, 3 zeros back to back to back in the first 3 years of the sequence here, which is pretty awful. But what I also did was I took a look at historical borrowing rates during this exact same period of time here with one of our lenders, and it looks like this. So the current borrowing rate as of April 2023 is actually lower than 7.82%, which would have been in the year 2000. So we have a terrible recession that we're modeling here for the first 10 years, and we have borrowing rates actually higher than they are currently. But the reason this is so important to show is that this is the concern that folks have. What happens if borrowing rates continue to increase, and what happens if we simultaneously go into a pretty deep recession here? What I'm showing people is that, historically speaking, there has been a 2-year lag period between a market correction and an interest rate adjustment. So what I mean by that is if you look at the first year in the sequence, the year 2000, that was the first year of the dot-com bubble bursting. If we look 2 years later, we see the borrowing rate drop from high 7% to low 4%. And then it decreases down to 3.67%, decreases again down to 3.35%. And then if we look at 2003, when we come out of the dot-com bubble bursting, the S&P 500 produced a 32.19% return. If this was an IUL, they would have hit the cap, assuming the cap is 10% in this hypothetical scenario here. 2 years later, the borrowing rates start to increase again, right? From 3.35% to 4.55%, up to 6.62%, up to 7.44%. And then we see it start to come down again. And the big drop is when we go into the mortgage crisis in 2007. Again, 2 years later, that borrowing rate would have dropped from 5.24% to 2.55%. So it would have essentially got cut in half. Now, this is the story or the narrative that really needs to be told regarding premium financing, especially right now, because you have to get the client to understand that you don't premium finance because the borrowing rates are low, and you don't not premium finance because borrowing rates are high. What you have to look at is, again, the historical relationship between borrowing rates and crediting rates, and you also have to understand the cycle that the borrowing rates go through, again, in this scenario, 2 years after a market correction, whether that market correction be a negative one or a positive one. Okay, so let's take a look at what the forward curve rates look like. The forward curve rates are based on what the so-called smart money folks believe are going to happen to borrowing rates in the future. They usually project this out 14 years out from current. The forward curve rates are published quarterly. This one just came out at the end of first quarter, March 31st, 2023. And what this graph shows here is the current borrowing rate with one of our lenders as of April 18th. The all-in borrowing rate would have been 6.20%. That is the base rate plus the lender's spread. And using this scenario here, this is SOFR plus 140. The forward curve rates based on this type of loan construction are projecting that next year the borrowing rate would tank down to 4.49%. And then they're projecting a very slow yet steady increase to where over the next 14 years or so, that borrowing rate will get just north of 5%. If you want to learn more about the forward curve rates, you can certainly look that up on the internet. There's tons of information that explain what the forward curve rates are based on. So at least it gives you kind of a different perspective on what might happen in the future. What's interesting about this forward curve rate graph here is that it is right in line with what I just talked about regarding the 2-year lag. So last year in 2022, the S&P produced a negative return of negative 22%. So if we look at that 2-year lag period that we just discussed, it would make sense that 2 years later in 2024, because of that crash, that the borrowing rates should decrease again, based on that 2-year lag theory that we just looked at regarding historical borrowing rates and crediting rates. So that narrative fits right in line with what these forward curve rate projections are depicting on this graph right here. So I think what's extremely valuable about our backtesting software is that we can model all of that type of volatility and the historical data that we just talked about. On this particular graph here, this black line is the as illustrated death benefit net of loans, assuming a 5.4% static return inside the policy. And these numbers were taken right out of the carrier illustration, assuming that 5.40% return. The blue line here, those values are taken right out of the carrier illustration and are a depiction of the ongoing net cash surrender value, again, as depicted in the carrier illustration. The dotted green line there represents the synthetic account value in our proxy, in our backtesting software, during the 40-year period that produced the worst compounded annual growth rate out of 121 different historical 40-year periods that we analyze. And then up top there, the heavily dashed green line shows a simulated account value during the best 40-year period in our backtesting software. But what's really interesting, and quite frankly, what I find arguably the most interesting, is the solid green line here. Those are the simulated account values in our backtesting proxy, assuming the first 22 years are between the years 2000 and 2021, which again started out with the worst decade in modern history, right? The years 2000 through 2009. Again, there would have been 5 zeros in the first 10 years in terms of index credits. And then after those 22 years, then we level it off and we use 5.4% returns simply because that's what we ran in the carrier illustration. Now, over this 40-year period, the synthetic cash value in the proxy is significantly more than the blue line, which is the as illustrated cash value, roughly 50% more over that 40-year period, which should give the client a lot of confidence regarding how the premium financing arrangement has been structured and being able to withstand a terrible recession going into the first 10 years of that 40-year sequence. Again, during that time, we're using historical borrowing rates that match up with the historical simulated index credits. So it's really more of a fair historical depiction. The other green lines, the dotted green line and the dashed green line, assume a steadily increasing borrowing rate. Despite the fact that the forward curve rates do not indicate that that's going to happen, we still run the dotted green line and the dashed green line. Again, that's the worst 40-year period and the best 40-year period, assuming a steadily increasing borrowing rate. Again, just to be conservative. So this is the new premium financing platform that I developed just a few weeks ago here. We call this 6th year financing, and this is specifically designed for accumulation and retirement income. The reason I developed this was because of this concern of the increasing borrowing rates. And this was also developed because one carrier specifically, Pacific Life, has some relatively new increased parameters that they put around how we can show premium financing with their products. And I'll get to that in the loan model on the next slide here. So the ways that 6th year financing is set up is the actual policy premiums in this particular design here. This is a male age 50, preferred non-tobacco. First 5 years of this design here use $250,000 in annual premium. In the scenario here, the client is going to pay 100% of those premiums out of pocket, non-financed, for the first 5 years. Then starting in years 6 through 10, the premium jumps up 3x from $250,000 to $750,000. Of that $750,000 annual premium, the client is going to pay some of those premiums out of pocket. They are going to borrow the balance of that, and then they're going to pay the interest out of pocket on those decreased borrowed premiums. So the client is going to pay, again, the combination of some premiums and the interest out of pocket on the borrowed premiums in years 6 through 10. What we're trying to do here is design this so that the client is going to pay roughly $250,000 per year for a period of 10 years. Now, obviously, The out of pocket that they're going to pay in year 6 through 10, we're trying to keep it around 250,000. It might be a little bit more, it might be a little bit less, depending on the borrowing rates during years 6 through 10, which is obviously going to be determined at that time. The nice thing about this design here is that there should be no outside collateral needed, simply because you have 5 years of non-finance premium unencumbered by any third-party debt going into the policy for the first 5 years. So again, that's why we call it 6th year financing, because the financing actually starts in the 6th year. And then we're exiting the loan via the policy value in policy year 11. So in and out in 10 years. Very, very simple. Pacific Life specifically, the reason we designed this with that particular carrier in mind, and you could use several other carriers with this design as well, but the reason that we're focusing on Pacific Life is they want to see the borrowing rate increase 100 basis points from today's borrowing rate starting in policy year 3. In this scenario here, we don't start borrowing until year 6, so we have that borrowing rate increasing 100 basis points starting in year 6, and then they want to show that borrowing rate stay level from there on out. So that's what we're doing here, just basically following Pacific Life's new premium financing guidelines. We're starting with a borrowing rate relatively high, 6.8%, and then that borrowing rate is depicted here, increasing to 7.8%, which again is far higher than what the forward curve rates would indicate. But again, we're doing this just to be overly conservative. The question is, how does this stack up against a non-financed policy? So we use the same exact product, same carrier, same everything. In the orange section here, this is the non-financed premium of $250 a year in years 1 through 5, and then years 6 through 10. That premium increases at the same amount that we are showing in the financed policy. So same out of pocket in both scenarios here. If we're doing this for income purposes, we're showing income starting at age 65. On the non-finance policy in the orange, that allows $199,000 per year, starting at age 65 and then continuing to age 90. In this particular depiction here, we're only showing a 40-year window, and in year 40, the client would only be 89, but we are running the assumption out to age 90 in terms of income, and we're assuming that the policy will stay in force until age 120. On the financed side of things, in the green section there, the income jumps from $199,000 up to $233,000. So the total income drawdown is almost $1 million greater over this 40-year period. And if we look down at the bottom there, we see that the line just above the red box, the year 40 cash value in the non-finance policy is only $761,000 versus $1.4 million in the financed policy. If we add up the total income drawn down plus the year 40 cash value, in the non-finance policy, we have $5.7 million versus almost $7.3 million in the finance policy, which is a difference of over $1.5 million in total economic value. Again, same exact product, same carrier, same dollars in, significant difference in dollars out. This is a page taken right out of our report that goes along with the proposal. Up top there in the green, we have $2.55 million going in to the financed policy and a total economic value of just shy of $7.3 million over the course of 40 years. In the orange section, same dollars in, but we have a significant decrease in total economic value after 40 years at $5.7 million. And then in the blue section there at the bottom, same dollars in, going into a non-insurance based investment account, 70% equities, 30% bonds. Equity returns, we're showing historical S&P returns, including S&P dividends, and bond returns, we're showing historical 10-year T-bond returns. We are assuming 1.35% in all-in investment fees, which is about 50 basis points as an advisor fee, 32.6% in capital gains tax, and we're assuming the same 5.73% return that we're showing in the policies, gross return. And the total economic value over 40 years is only $3.9 million. Pretty big difference. Pretty hard to dispute that. If we look at the back-tested scenario here and compare that against what the carrier illustration is showing, Again, in the blue line right there depicts the cash surrender value net of loans, assuming that 5.73% static return. Those numbers are taken right out of the carrier illustration. The dotted green line is the account value in our proxy during the worst 40-year period. There it is in the best 40-year period. And then that solid green line is during that newly synthetic design that we show the backtested returns during the years 2000 through 2021 for the first 22 years, and then a static return of 5.73% thereafter until year 40. So I love showing this slide right here because it really shows the client that carrier illustration is extremely conservative relative to what things would look like with actual historical volatility. We're also going to show this depiction here against a non-insurance based investment account, back tested, which again, numbers are quite staggering. Left-hand side of the screen is the best 40-year period. Right-hand side is the worst. Up top there, the green bars represent the income drawdowns out of the finance proxy, and the blue bars represent the income drawdowns from the non-insurance based investment account using the same back-tested historical periods of time. And at the bottom there, that is the ongoing account balance, including or taking in consideration those income drawdowns. As you see, the blue lines were drawn down to zero before we hit the end of that 40-year period, which is why the income drawdowns are so much less cumulatively. Again, if we compare it to the non-financed proxy in the back-tested scenario here, again, green is financed, orange is non-financed. So again, if they're looking at putting the same money into the same product, non-financed, with no leverage whatsoever, the leverage is proofing positive very nicely here. And then the last thing I'll show you here is just an overlay of the finance proxy versus non-financed versus the non-insurance based investment account in the blue. Pretty darn compelling. So again, the reason that we developed this new financing platform, 60-year financing, is to address the concerns, one, of collateral, two, of borrowing rates. In fact, some clients we have found really like this because they do believe that the forward curve rates are accurate, or at least realistic, or reasonable, I should say. If we go back to the forward curve graph here, if you have a client that believes that borrowing rates are going to come down, 60-year financing can make a lot of sense for them, just kind of from a cerebral perspective, because if borrowing rates are higher this year and they believe that the borrowing rates are going to decrease over the next several years here, that if you start financing, say, in year 6 as opposed to year 1, they would essentially circumvent the current higher borrowing rates in today's environment. So again, this is all crystal ball stuff to a certain degree. Nobody knows what the market is going to return. Nobody knows what the index are going to credit. No one knows what the caps are going to be, and no one knows what the borrowing rates are going to be in the future. But if we really stick to the narrative of let's not make decisions based on what we think market performance is going to do this year or what we think the borrowing rate is going to be over the next 1 to 6 months, but instead look at history and look at the symbiotic relationship between the borrowing rates and crediting rates. Historically speaking, there's been a nice, healthy, positive arbitrage between borrowing rates and crediting rates regarding premium financing. And we've got more data than you can shake a stick at to show a very analytical client what those historical numbers look like. But hopefully this overview of what I see happening in premium financing right now is helpful. And as always, you can always contact me directly if you have any questions or any potential cases to work on together. All right, guys, have a great day. Darren Sugiyama signing off.